Hello, everyone, and welcome to Nomura Podcast. I'm your host, Yuben Paracuelas, Chief Southeast Asia Economist at Nomura in Singapore. In this episode, we will focus on the year-ahead outlook for Japan, which we expect to remain on a recovery path in 2026. I'm very delighted to be joined by a great lineup of my colleagues in Tokyo. Kyohei Morita, Chief Economist for Japan, Yujiro Goto, Head of FX Strategy, Tomohaki Shishido, Senior Rate Strategist, Tomochika Kitaoka, Chief Equity Strategist. We will feature our top views on the economy, the risks to watch out for, and the implications on FX, rates, and equity markets. Let's dive in. Okay, Morita-san, starting with you on the economic outlook on growth for 2026. You seem to be seeing a recovery based on your forecast. What are the key drivers to that?
Right. When we say we expect the Japanese economy to remain on a recovery path toward 2026, we always assume two demand components to drive the economy. One is capex. Capex in Japan used to be sort of like a derivative of exports. Like capex will decline when exports decline. Capex will pick up when exports pick up. But going forward, we believe capex will be like a factor to bring about the trend of the recovery, because the driver of capex will look different going forward. We believe the shortage of labor force will support capex going forward. In order for companies to reduce labor dependence, so capex like digitalization, automation, software, AI, that kind of capex will be critically important going forward. So that will be one of the drivers to support the economy. The other is actually private consumption. We expect the two factors will support consumption going forward. One is the economic package taken by the new prime minister, i.e. Takaichi. Her most recent economic package includes support for households under cost-pushing inflation, including an expansion of deductible income or the abolishment of the provisional gasoline tax. Those will support purchasing power of households and hence consumption. Also, as we talk about later, we expect Japan's CPI inflation to come down to below 2%. And that will probably support real wages going forward, which in turn will support consumption. So capex and consumption will be the major drivers for Japan going forward.
Okay, yeah, that's super interesting. And then on the BOJ, which is obviously a very important topic, it's been an important topic. What do you think is the terminal rate versus the BOJ's estimate of the neutral range? And by when do you forecast that to be reached?
Right. We believe the BOJ's terminal rate will be 1.25%, 1.25%, which implies 3 more hikes going forward. And that lies close to the lower end of the estimated range of Japan's neutral rate, which is somewhere between 1% and 2.5%. We think we will reach that neutral rate of 1.25% in July 2027 after pausing for a full year in 2026. We expect an out of consensus long pause, 1-year pause by the BOJ in 2026, mainly because we expect CPI inflation to come down to below 2% throughout 2026. But again, the terminal rate will be 1.25% to be reached in July 2027.
Okay, so still a very gradual pace of normalization, I guess is the way to put it. Now, turning to Goto-san on the Japanese yen, what is your forecast throughout 2026, and is that mainly driven by an interest rate differential angle?
Yes, so we expect the Japanese yen to trade still relatively weakly in the first half of 2026 above 150 against US dollar. But in the second half of the year, Japanese yen's recovery is likely to accelerate, and we are targeting 140 by end of the next year. And the Bank of Japan's policy stance will play a very important role here. So since July, Japanese yen has been underperforming, and we judge one of the key reasons behind the weakness is changes in Japan's politics. And changes from the Ishiba cabinet to Takaichi cabinet increase market expectations for more dovish policy stance both in fiscal and monetary policies, which added major downward pressure on the Japanese yen. So Takaichi's stance towards the BOJ inflation and the Japanese yen is quite an important factor into the next year. And in this regard, especially we need to monitor the tolerance of Takaichi administration to yen weakness, as both inflation and yen weakness have been major political problem in Japan recently. This is a major reason why the BOJ is now widely expected to hike in December, and the Takaichi administration supports BOJ's decision most likely. And in this regard, Japan's inflation is actually likely to slow temporarily early next year, thanks to the base effect from the rice price and the government policy to lower gasoline price. And therefore, Takaichi administration may feel more comfortable with weaker yen in the first quarter or first half of next year. However, we believe that Japan's inflation problem will be even worse in the second half of 2026, especially when yen trades weakly. And then a much stronger yen, Japanese yen, is necessary to avoid inflation overshooting and BOJ's behind the curve scenario. And Takaichi will encourage the BOJ to consider rate hikes more quickly into 2027. We also expect the Fed to cut twice next year and sustain to narrowing the rate differential between the US and Japan in the second half of 2026 and 2027 should weaken dollar yen toward 145 or even toward 140.
Okay, yeah, makes a lot of sense. And it seems like towards the back end of 2026, you're expecting a significant appreciation, actually, of the Japanese yen. And you talked about the tolerance of the Takeichi government on Japanese weakness. But what about the other side when it's significantly appreciating as you expect? Have you taken into account the possibility of possible MOF interventions?
Yeah, so actually, we do not expect the MOF to intervene in the FX market proactively to push the yen down to 150 or below, as such action may not be welcomed by the US counterpart. However, we see a chance or risk for the MOF to intervene in the market when yen weakness pressures increase and the yen approaches toward 160 again. So intervention risk will especially increase after the BOJ's hike, likely at December meeting, because MOF can state that the yen weakness after the BOJ hike is not justified by market fundamentals. So risk of the intervention will likely limit upside room of the yen from here, and such expectation will encourage market positioning to shift toward the yen short positions gradually into 2026.
Okay, that's great. Thanks. And then now turning to Shishido-san, long end bond yields have been rising quite substantially, especially in recent weeks. Do you see scope for further increases into 2026?
We think 10-year JGB yield will rise further next year to the level higher than 2%. So naturally, those higher rates in 10-year or 5-year sector means higher long end yield as well. But at the same time, we don't think further steepening of the 10-year, for example, 10-year, 30-year, or 10-year to 20-year curve. So I think the 10 years 30 or 10 year 40 will stay relatively steep, but we don't expect it become steeper. So we will see a stable spread between long and 10 year, and possibly some modest flattening could occur in the next year because Japanese long and JGB yield has been pushed up by many non-fundamental factors such as sudden and rapid decrease of purchases by Japanese life insurance companies and related overissuance in the last fiscal year and the first half of this fiscal year. And after the announcement of Trump policy in April, the liquidity in super long GGBs and swap super long sector decreased dramatically, which also put some kind of liquidity premium on long and yield. So we expect those premiums will decline slowly. That's because we expect a slow improvement in market functioning and liquidity situation in super long sector. So net, I'm not that very pessimistic about the long end of the JPY yield curve, especially in relative terms. Maybe we will see a higher long end yield next year. That's probably because due to higher 10-year yield, not the steepening of 10-year, 30-year, or 10-year, 20-year curve.
Yeah, okay, got it. And is there any part of the curve that you find more attractive and could outperform in the coming year?
Yes. So in that sense, we see a good value in long end of the JGB yield curve. Maybe swap has also have some attractiveness in super long end, but the yield of JGB is much higher than swaps in long end of the curve. So we think the most attractive sector is now currently in the super long end 30-year. Maybe 25-year sector is relatively cheap due to idiosyncratic demand supply balance factors. So yeah, 25, 30 year offer a good value in my opinion. On the other hand, 10-year sector has been rich for a very long time, and we are seeing some correction in this richness in very recent, in the past 2 to 3 weeks. But still, 10-year sector has been, in my opinion, is somewhat rich.
Okay, yeah, got it. Thank you very much, Shishido-san. Now let's go to equity markets with Kitaoka-san. How do you see Japan's equity markets with the economic backdrop that Morita-san talked about? How do you see that evolve in 2026, considering that recovery, but also rising interest rates environment?
Yes, we see the Japanese equity to maintain a modest uptrend in line with 6 to 7% of expected return in 2026 because of mainly three reasons. First, nominal economic growth rate is likely to be bigger than nominal 10-year JGB yield even after the repeated upside pressure for JGB. And second, the expansion in EPS supported by volume expansion as well as price increase. We see 14% EPS expansion in fiscal year 26 or March 27. And thirdly, decline in equity outstanding as after the repeated corporate buyback cancellation and takeover bid, TOB and M&A boom. So our base case for topics at the end of next year is 3,600, and as for Nikkei 225, 55,000 yen. And we assume modest negative impact from the increase in the debt burden. The corporate interest rate debt burden may be increased by 50 basis points in next 12 months time horizon. But as I mentioned, volume expansion and price hike may offset more than 100% for next fiscal year EPS in our top-down model.
Okay, and what about the specific sectors? Anything that you're more positive on, and those that can outperform in that backdrop?
At this moment, we prefer electronic appliances, machinery, including defense and AI semiconductor, as well as banks and real estate, and trading companies. Instead, we are cautious on steel sector and retail sector, as well as inbound related sectors. Especially B2B or business to business type business model may provide a good performance through their capex boom and also price hike culture, because the B2B business may have a good excuse for price hike. That is labor shortage. Relatively easy for them to focus on a profitable business and decline to the unprofitable business because of the labor shortage. This is exactly happening in the real estate and construction and IT software, hardware, and so on. But unfortunately, B2C, consumer business, are not so good at such a price hike at this moment.
Okay, got it. Yeah, thanks very much, gentlemen, for those interesting views. Before we close, can I just do a quick roundup in terms of the risks? We know there's quite a bit of uncertainty still globally. If you can mention the main risk you're watching for 2026, that would be very interesting. Starting with you, maybe Morita-san.
Yes, we do see some risk factors affecting our view on the economy and on inflation. In terms of the economy, the most recent renewed tensions between Japan and China, if that kind of tension intensifies or extends longer than we expect, some demand component like inbound tourists, i.e. service exports, that could be dampened more deeply than we now expect. So that's one risk we face in terms of the economy. And in terms of inflation, if the yen becomes weaker than we expect, translating into faster imported inflation, that could lead to a change in our base case where we expect a one-year pause next year. If inflation intensifies for whatever reason, that could front-load the BOJ's rate hike or hikes into 2026. So those are the risks we are aware of now. Thank you.
Okay, thanks. Goto-san.
Yes, so I think Japanese politics can be major risks for Japanese yen again in 2026, either negative or positive for the Japanese yen. So if Takaichi administration will really chase much weaker yen to support the economic activity, we may need to consider undershooting of Japanese yen toward 165 or 170 against US dollar. On the other hand, if for some reasons, Takaichi loses her power very quickly. Market assumption for dovish policy mix may need to be reconsidered, and Takaichi trade position is going to be unwound very quickly, which can strengthen Japanese yen quite quickly, or more quickly than we currently expect. So politics is again a key focus in Japan next year, in my view.
Okay, wow, that's interesting. Yeah, domestic political factors. What about Shishido-san?
I also think that politics, especially in terms of rates market, fiscal policy is the major risks. So as you know, Takaichi administration's advocate for expansionary fiscal policy, and her first act, which was the supplemental budget, economic policy package, was noticeably larger than rates market expected, which caused the latest increase in 5-year, 10-year interest rates. So if she passes further expansionary or larger than expected fiscal deficit policy, then we will probably see a much faster rate hikes or much faster rate increase in 10-year or even long end of the yield curve.
Okay, that's clear. And then finally, Kitaoka-san.
So in addition to such a global agenda such as AI or IT cycle, the Japan-specific factors, I like to emphasize the corporate governance reform, both upside and downside, because there are two groups, much more progress or retreat. In that sense, one milk one is in middle of next year, corporate governance code reform will be scheduled, where the much more efficient usage of cash and deposit in corporate balance sheet is one top agenda. I like to see much more efficient usage of cash and deposit. That is much more increase in the capex as well as increase in the return to shareholders both. But there are some backlash on this reform, so be careful about this situation.
Okay, great. Let's leave it here. Thank you very much, all of you, for joining this discussion. I think we've learned a lot. You've provided a lot of clear insights for our audience to take away from into 2026. Really appreciate it, and thank you again.
Thank you very much.
Thank you.
Thank you very much.
Well, that's it for now. Thank you again for listening to our podcast, edited and produced by John Dalton. Please like and subscribe to Nomura's podcasts on Apple, Spotify, and SoundCloud, or your usual podcast provider. We'd love to hear your feedback, so please feel free to write a review and share this podcast to anyone you think might be interested. You can check out NomuraConnects.com for more of our research and updates.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting, or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.